Let me tell you something right here, and I want you to really listen. In this game, the consistent profits have never come from trying to predict each little up and down or grabbing small, fleeting gains. No, my friend, real success comes from aligning yourself with the major shifts in perception. Those big market moves that unfold when collective beliefs change. But here's the issue. Most traders never recognize them until they're already gone. And the reason is simple. They're too busy being emotionally attached to every tick, reacting to every fluctuation, hoping the market gives them what they want, instead of seeing what it's actually showing. Have you ever caught yourself watching every tick, questioning if you should buy, sell, or wait, only to realize the real move has already happened without you? That's what I mean. Traders love to believe there's a secret formula, a hidden system that tells them what's next. But the truth is, the market reflects collective psychology, and it's always showing you everything in real time. It's not hiding. It's you who can't see clearly. Because fear, greed, and the need to be right cloud your perception. You know why that happens. Because most traders think in terms of money, not probabilities. They focus on what they hope to gain or lose, instead of understanding what the market is communicating. Until you detach from that emotional need, until you start observing without projecting your desires, you'll never perceive those major shifts as they begin. I learned that the hard way. Every lesson I ever paid for, I paid twice. Once with money and once with emotion. The market doesn't hand out discounts. It teaches by exposing your weaknesses, by forcing you to feel the consequences of attachment and resistance. Have you ever felt that sting when you know you're wrong, but can't bring yourself to exit? You hang on, hoping the market will come back to justify your belief. We've all done it, and that's exactly why most traders miss the big moves. They care more about being right than about being aligned with reality. Here's the truth. A major move starts in the collective mind of the market, long before you see it on a chart. The chart is the result, not the signal. The first clues come from shifts in behavior, in how the market responds to new information. Does it rise on bad news? Does it fall on good news? That's not random. That's a shift in beliefs. That's the subtle transition before the crowd realizes what's changing. You've got to ask yourself, if the market stops reacting logically to the news, what is the underlying belief structure preparing for? That's where the next major move is born. But most people need reasons. They need to tie every tick to some headline, to justify their comfort. Yet the biggest moves always begin when the logic breaks down, when the crowd's expectations no longer match price behavior. Have you noticed how you think you understand the story, but the market begins writing a new one before anyone else catches on? If you're aware and emotionally neutral, you'll see it. If not, you'll miss it and spend months wondering how others saw it first. Now don't misunderstand me. You can't predict the future. Nobody can. What you can do is recognize shifts in probabilities faster than the majority. That's what it means to find the big moves first. Recognition requires a mind free from bias, one that observes what is, not what it wants to be. Can you honestly say you look at the market without expectation? Or are you secretly hoping, praying, calculating profits before you've even accepted the risk? The traders who excel are the ones who can wait, who can let probabilities align before acting. Waiting is the hardest thing in this business because the mind craves action. But markets reward patience, not activity. The big opportunities don't appear every day or every week. Sometimes months pass before one emerges, while you chase small moves. The real one is forming quietly. By the time it's obvious, it's too late. Have you ever traded in and out all day, only to watch a market move 100 points in the direction you once believed in, but abandoned too soon? That's the psychological cost of impatience. When the market begins to shift, it leaves clues in volume, persistence, and behavior. You'll see price test certain levels repeatedly, and most will interpret it as exhaustion. But that's where the collective belief is being tested. Each retest is a buildup of pressure, and when it breaks, that's the release of conviction, the start of the big move. Have you seen a market that refuses to fall, no matter how much selling pressure comes in? That's the crowd's disbelief battling new emerging confidence. But here's where most traders fail. They talk themselves out of acting because the situation doesn't feel perfect. It's gone too far, they say. I'll wait for the pullback. And while they wait, the move accelerates. The market punishes hesitation because the mind still seeks certainty. And certainty doesn't exist. Let's talk about courage. To align with a big move early, you must act when the evidence points to a shift, even when the crowd disagrees. That feels uncomfortable because your beliefs are being tested. The crowd will call you reckless for acting without confirmation. But that's what belief in your process looks like. The market rewards independent thinkers who can trust their observation over consensus. Being early doesn't mean guessing. It means acting on a buildup of probabilities so strong that hesitation itself becomes risk. Most traders either act impulsively with no evidence or freeze when the evidence is overwhelming. That's why they miss the big moves. And understand this: you don't need hundreds of big moves to build wealth. You need a few, but you must be mentally ready when they come. Readiness isn't about capital. It's about mental neutrality. You can't act clearly if your perception is clouded by past wins or losses. Every trade must be a new moment, free from emotional baggage. Think about it. Every major market shift begins as an emotional imbalance in the collective crowd. When fear or greed becomes extreme, opportunity arises. You don't need to predict. You just need to perceive faster. The market records everything, but it doesn't interpret it for you. You must read the behavior, the footprints of institutional conviction. When you see accumulation, when you see quiet strength or weakness that defies logic, that's the deeper rhythm of belief changing. But let's be honest, most traders won't do this. They'll agree in theory, but when the time comes, they'll act on impulse or gossip. That's human nature. We want to feel safe in the herd. Yet the market doesn't reward comfort. It rewards discipline and awareness. The market will tempt you with small profits, little hits of emotional relief, to distract you from the bigger reward. You take a quick gain, feel validated, but miss the exponential move. The small wins are bait. The real edge lies in holding your conviction through uncertainty, sitting tight when you're aligned with the market's behavior. That's mastery. It's not about buying or selling. It's about staying centered. The market will test your belief with retracements, with doubt, with noise. Most traders abandon their positions when uncertainty rises, only to watch the move continue without them. That's the pain of being right, but acting from fear. Big moves take time to develop. They unfold as the crowd slowly accepts what a few already know. You can't rush that. It's like a psychological tide, steady, inevitable, and powerful. The ones who profit most recognize it early and allow it to evolve. The rest stay trapped in reaction, missing the shift happening right before their eyes. And here's something subtle. Sometimes the best clues come not from what the market does, but from what it doesn't do. When bad news no longer causes decline, or good news fails to create rallies, that's the collective mindset changing beneath the surface. The key is to notice these exceptions, not the rules. The leaders always reveal themselves early through consistent behavior that defies logic. The signal is faint, but clear to those who are calm enough to observe. You must balance patience with readiness. Act when probabilities shift from possible to probable. That's when alignment happens. Finally, remember, being early doesn't mean being careless. You must always define your risk. True confidence is born from accepting that you can be wrong. That's freedom. You can't catch the big moves if you fear being wrong, because certainty never comes. The best you can have is a probabilistic edge, and trust in yourself to act on it without hesitation. That's how you find the big moves first. They want safety. But in this business, safety is an illusion. The only real safety lies in aligning with probability and risk control, acting when the conditions support your edge, defining your risk, and letting the market show you whether your belief is valid or not. Are you willing to accept that kind of uncertainty? I'll say it again. The market never hides opportunity. The big moves are always there for those who've trained their perception to recognize them. But recognition isn't enough. You've got to act on your edge and let the outcome unfold without attachment. That's the essence of consistency. If you want to call it a secret, here it is. Observe the market without bias. Listen to what it communicates through price behavior. Act when the probabilities align. Cut your loss instantly if your thesis fails, and hold steady if it confirms your belief. That's how you participate in the major moves early. Sounds simple, doesn't it? Then why do so few manage it? Because the obstacle isn't the market. It's you, your fear, your greed, your need to be right, your attachment to outcomes, and your discomfort with uncertainty. The market itself is neutral. It doesn't care whether you win or lose. It simply reflects the collective beliefs of everyone involved. The real challenge is mastering your internal state so you can perceive and act clearly. So I ask you, can you do that? Can you operate without needing reassurance from others? The truth is, most can't. That's why consistent success is concentrated among a small few, not because they're smarter or luckier, but because they've mastered their mental environment. They've learned to act without the need for external confirmation. They trust their process, their edge, and their understanding of risk. If you can do that, you'll consistently be ahead of the crowd. If not, you'll always be reacting, buying tops, selling bottoms, convinced the market is against you. Have you ever felt that frustration, as if the market were conspiring to make you wrong? It isn't. It's just revealing how your expectations conflict with reality. Every losing trade is simply feedback on your state of mind. Think back to your last trade. Did you act because you saw something objectively in price behavior, or because you felt the pressure of missing out? Did you stay in the trade because the market was confirming your edge, or because you were afraid of regret? Did you exit because the data changed, or because your emotions couldn't handle the heat? Be honest with yourself. Until you start answering those questions truthfully, you'll keep repeating the same mistakes, and the next big move will come and go without you. Patience is your edge. That may sound cliché, but it's the real separator between the trader who thrives and the one who burns out. The market doesn't reward movement. It rewards alignment. It doesn't pay the trader who constantly acts, but the one who waits until probabilities are in their favor. Have you ever felt that restless urge to trade, just to feel alive in the game, even when no valid setup exists? That's not discipline, that's addiction, and patience is the antidote. More traders destroy themselves through overtrading than by missing opportunities. Doing nothing feels uncomfortable because the ego equates inactivity with weakness. But the trader who waits loses only time. The one who forces trades loses capital and confidence. The market punishes impatience with surgical precision, offering bait in the form of minor moves that collapse the moment you commit. How many times have you chased a rally only to watch it reverse? How many times have you shorted a dip only to see it recover without you? If you'd done nothing, you'd be in a stronger position, mentally and financially. The mistake is confusing activity with progress. Many believe that trading more means improving faster, as if effort alone creates reward. But the market doesn't compensate for effort, only for clarity and precision. You can only be right when the context supports your edge, and that requires waiting. It's like hunting. You don't fire at every sound in the brush. You wait for confirmation of your target, the alignment of all your conditions. Acting prematurely scares off your opportunity. The same applies here. The large moves, the ones that redefine accounts, take time to develop. They are the result of psychological build-up, accumulation, distribution, shifts in conviction. These processes unfold gradually, often invisibly. The market that seems stagnant may be preparing for a breakout of belief, but only the patient trader will be positioned for it. The impatient one trades in and out until he's exhausted, emotionally depleted, financially drained, and mentally doubtful, right when the real move begins. Haven't you been there, waiting months for a setup, only to be too fatigued to act when it finally comes? That's the tax of impatience. Patience means allowing the market to reveal intent through repetition and behavior. One day of strength or weakness means nothing. But when you see persistence, when a stock holds firm under pressure or advances despite selling, that's conviction revealing itself. It takes time to form, and most won't wait long enough to see it. They jump in on one strong day and bail on one weak day, tossed about by emotion rather than observation. The patient trader, however, lets the narrative unfold until the probability of being right outweighs the risk of being wrong. Which one are you? And even when you're in a good position, patience remains essential. The big moves unfold in waves, expansions, pullbacks, tests. The market's purpose is to challenge conviction, to flush out those who can't emotionally tolerate discomfort. If you can't endure that process, you'll sell too soon. Then you'll watch from the sidelines as the market delivers exactly what you anticipated, but without you in it. That's the emotional tuition every trader pays until they learn the value of emotional control. Patience isn't passive. It's an active state of mental equilibrium, the ability to remain still while your mind screams for action. It's not just about waiting. It's about staying centered once your edge is engaged. The real work of trading isn't clicking the button. It's maintaining belief in your plan while uncertainty unfolds. Do you have that belief? Or do you let each tick chip away at your confidence? Many destroy perfect trades by overmanaging them, entering correctly, then cutting in and out in search of perfection. They lose not because they were wrong, but because they couldn't sit still. They confused motion with intelligence when in fact it was emotional noise. Patience also means distinguishing between crumbs and feasts. The market constantly tempts you with small gains. The illusion of progress. You take a quick profit, feel smart, and miss the larger move. Those small wins are psychological bait. They soothe the ego while stealing your real potential. How many times have you sold for a minor gain, only to watch the position run far beyond your target? The hardest thing in trading is to do nothing when there's nothing to do. Human nature resists stillness. It wants control, certainty, validation. But markets don't bend to emotional needs. They reward those who can wait for alignment. That's why patience is the real edge. It's rare. Most can't do it. They'd rather lose money than sit still. The few who can, who wait for alignment and hold through uncertainty. Those are the traders who consistently extract wealth from the rest. Which kind of trader do you want to be? Let me put it plainly. A trader's greatest weapon isn't his analysis or his chart or his capital. It's his ability to stay still, to sit through the noise without interference. That's where consistency is born. The market will tempt you. The crowd will mock your restraint. But if you can wait, truly wait, the market will eventually align with your readiness. And when it does, you'll already be positioned while everyone else scrambles in confusion. Patience is the edge because it puts time on your side. The impatient trader fights time. The patient one lets it compound his probability. The former demands the market to perform, the latter lets the market reveal. That's the difference. And it's everything. So ask yourself, can you train your mind to wait, to hold, to remain calm while uncertainty rages? Or will you keep surrendering to emotion, paying the same psychological price every time? Strength shows when the market refuses to break under pressure. Weakness shows when it can't rise. Simple, yes. But that observation is the cornerstone of awareness. The market speaks through behavior, not words. Its reactions to pressure reveal the collective belief before the crowd realizes it. That's where your earliest and clearest signals always come from. Have you ever watched a market that seems to have every reason to collapse, yet it holds steady, even ticks higher when everyone expects it to fall? That isn't luck or coincidence. That's psychological strength. A shift in belief forming beneath the surface. And the trader who focuses on that behavioral strength, instead of reacting to news or narratives, is the one who aligns first with the next major move. Most traders don't think this way. They believe a market that drops on bad news is weak, and one that rises on good news is strong. That's surface-level logic. Obvious, comforting, and utterly unprofitable. The real money is made by noticing the exceptions, by seeing when the crowd's interpretation of information diverges from price behavior, when the market shrugs off bad news, when it rallies despite pessimism. It's revealing a shift in collective expectation, a change in probabilities. That's the market whispering a new truth, if you're willing to listen. On the other side, when a market can't hold gains on good news, when optimism doesn't translate into momentum, that's weakness, a fading belief. And weakness is just as valuable to identify as strength, because it often marks the turning point long before the crowd sees it. Haven't you noticed how leading stocks in bull markets begin outperforming quietly before the headlines praise them? Or how the weak ones in a bear market start faltering well before analysts sound the alarm? Price action reflects the truth of perception before any story catches up. Fundamentals, commentary, tips. They're secondary reflections of what's already being priced in. The only primary data is behavior, how price responds to new information. A company can announce terrible results, and if the market refuses to fall, it means someone with conviction Larger, more informed participants are stepping in. That's strength. Conversely, a company can release stellar earnings, and if its stock can't sustain a rally, it means distribution, informed selling into the good news. That's weakness. Do you see the distinction? Price behavior reveals alignment or conflict in belief long before anyone articulates it. Let me give you an example. You'll often see markets where most names sag under pressure, yet one or two defy gravity. They dip with the crowd, but rebound quickly, almost impatiently. That kind of resilience is the purest sign of accumulation. When broad selling ends, those are the names that explode first, leading the next wave. Haven't you wondered why certain stocks surge faster and go farther than others once the tide turns? Because the strength was being built while the crowd was still distracted by fear. The same pattern applies to weakness. Picture a rally where most stocks soar but a few lag behind. Heavy, unresponsive, lifeless. The crowd praises them for their value, their earnings stability, their long-term potential. But the tape, the behavior, tells another story. If they can't rise in an environment where everything else is flying, how do you think they'll behave when pressure returns? They'll lead the decline. That's why I always say, focus on how the market behaves, not what anyone says about it. The strongest stocks can't be suppressed. The weakest can't be sustained. Now, why does this matter for finding the big moves early? Because strength and weakness always manifest before the move itself. When large operators build positions, they don't broadcast it. They accumulate quietly, supporting the market during weakness. That's why prices hold firm when they should fall. That's your first clue. Evidence of conviction. By the time the obvious move begins, the professionals are already positioned. If you've been observing behavior instead of noise, you can join them early. The same applies to distribution. When big players want out, they sell into strength, keeping the price capped, even as the general market rises. The weakness is visible to anyone watching with a neutral mind. But most don't, because they're emotionally invested in stories and opinions. The footprints are there in plain sight, but only the patient and detached can recognize them. Most traders miss this because they're addicted to immediacy. They want instant validation, quick confirmation, fast results. They don't give themselves the time to watch behavior unfold over days and weeks. But strength and weakness aren't defined by one session. They're revealed through persistence. A strong market keeps rejecting lower prices. A weak one keeps failing to rise. If you're chasing momentary fluctuations, you'll never notice the deeper rhythm, the personality of the instrument you're trading. Haven't you done that before? Jumped in and out so fast that you never really saw what was happening beneath the surface? Understand this. When a market holds firm against a wave of bad news, it's not random. It's informed conviction. The participants stepping in against fear are usually those who understand something the crowd doesn't yet see. Their footprints are subtle but visible. Price refuses to break. On the flip side, when a market shows weakness despite favorable conditions, it's the same process in reverse. Informed money is exiting, transferring risk to the optimistic latecomers. They're not reacting to headlines. They're anticipating the shift in probability. That's why I say, trust behavior over commentary. The market's actions are cleaner, truer, and infinitely more revealing than anyone's words. I've lived through countless booms and crashes, and the pattern never changes. Before every great advance, the future leaders were already signaling strength through resilience. Before every deep decline, the weakest were already rolling over, while optimism still filled the air. The big move is never a surprise to the trader who studies behavior. The surprise belongs to those who chase headlines, confuse noise for information, and let emotion cloud their judgment. Which camp do you want to belong to? Now don't misunderstand me. Strength doesn't mean a stock never dips, and weakness doesn't mean it never rallies. Nothing moves linearly. What matters is character. A strong stock recovers quickly after setbacks, absorbing fear and coming back with energy. A weak stock fades quickly, unable to sustain hope. It's the way they respond to pressure that tells the story. Do you watch for that? Or do you let each headline pull your focus away from the deeper pattern, the entire art of trading? The real essence of it lies in interpreting behavior, seeing strength when others see randomness, recognizing weakness when others are blinded by hope. It demands patience, emotional control, and the courage to trust what the market is saying rather than what you wish to believe. That's how you stay in alignment with the truth beneath the noise, and that's how you find the big moves first.